The nominal GDP contraction is not very different, 22.6% on a year-on-year basis. Joining us to talk about the numbers, Kaushik Das of Deutsche Bank and Rahul Bajoria of Barclays. Thank you both so much for taking the time to speak to us. Kaushik, let me throw the first question across to you and just get your first thoughts on the headline number, and then we'll go into the breakouts.
Yeah, so we had a forecast of about minus 20%, and the range was between minus 15 to minus 25 if you saw the Bloomberg consensus forecast range. So it's not that surprising for the market, so it could have been, if it was above minus 25, that would have been more shocking. But I think this is more within the acceptable range that market was working with. So it's not like that shocking in my view. The only thing is there are some bit of, uncertainty with the public spending number, which has come minus 10% YOY, which generally analysts were expecting it to be positive. If you look at the government consumption side, actually government consumption in real terms were up 16% YOY, but the public spending on the GVA side was minus 10% YOY, which all analysts, I think, had a positive forecast, and therefore we are getting a little lower number of minus 20%. But this doesn't change the broad narrative that Indian economy has got a big shock, and it will take quite a bit of time to get out of this shock. And as economists, we would obviously see the YOY growth, but more important is to see the incremental growth, and also more important than that is to see the level of GDP, where we were in December 2019, and from there how much we have fallen and how long it is taking us to reach the December 2019 levels and then surpass it and grow. So from that perspective, I think we have a long way and a bumpy kind of recovery path going forward. That's my initial reaction to the GDP data.
Okay, Rahul, first thoughts from you as well, and then we'll get into the debate on public administration, etc.
Sure. So my sense is, as Kaushik, I think, summarized it, that this is quite a shock and not a big surprise, given the range of estimates. I think the area of disagreement probably within economists was more about the impact of the way we measure our GDP, not so much about the magnitude and the nature of the shock the economy was facing. I think it is fair to expect that the levels of activity will improve, but then at the same time, we have to be cognizant of the fact that the health crisis is something that is still very much with us. The numbers are increasing, and that is probably going to have almost a commensurate impact on discretionary activity. So while essential services, there's been a broadening in the way the lockdowns and then the unlocks have been operating, but certainly I would not celebrate the fact that there will be a pickup in activity and the GDP numbers in the second quarter of the fiscal year. What you have to kind of look at here is the level of activity, which I think will continue to remain relatively modest compared to the pre-COVID levels. So, there's no reason for the government to take any kind of solace from the fact that, activity levels appear to be improving at the margin.
Okay. Now let me get straight into the breakup. I'll start with the sectoral numbers, Kaushik. One issue, as you pointed out, of course, is this public administration issue. We were talking to Dr. Pranab Sen earlier. He said one possible explanation is that there is some discrepancy or some delay in data reporting from the state level. But if you go by the expenditure side data, government consumption expenditure is up, which is what you would expect in a period like this, right? Kaushik, you want to take that?
Yeah, so there are different ways to look at it. The thing is, normally you'll see both public spending and government consumption expenditure being directionally similar. So you could say that minus if you had a 16% YOY growth in government consumption, maybe the public spending would have been plus 10% or plus 8%. But normally you don't see a complete divergent trend of minus 10 and plus 16. So it's kind of baffling, and even at best times, we know that this quarterly GDP numbers tend to be very volatile and subject to a lot of revisions. So I think what Dr. Pranab Sen said is that in future course of time, we might see revisions to these numbers, which may make more sense. But, if you think about the broader narrative, I mean, if it comes down to, minus 20% or minus 18, it doesn't change the story that we're still under we are still under a big shock. And as Rahul mentioned that, we don't know how long it will take for normalcy to come back, because what happens is when you do an unlock 3 or unlock 4, and as mobility increases, there are risks of COVID-19 cases to also increase. So we don't know whether it will be a stop and start kind of an economy, and in 2 months' time, when we have more mobility, after some time you may see again numbers moving up, which may lead to further lockdown. So this is something which is going to stay with us for a long time till we find a vaccine or a cure. So we would be very cautious about drawing conclusions, even if we were to take a positive view of this government consumption going forward. We would be cautious about the growth outlook overall. And the other thing which I can think of, I don't know whether that makes sense or not. April, June last year, government in a normal year were much more proactive in pushing kind of spending. This year, April, June, they themselves were kind of caught in this lockdown and they could not push spending that much. But this still doesn't explain why there would be variance between the public spending and government consumption so much, and why such a variance between -10 and +16.
Rahul, maybe we should just put that down to all the data collection issues. I'll add on a question to that. Should one look, like you all often do, at GDP ex government, ex agri to then judge what the level of activity was?
No, absolutely. I think that's a very, very important number to look at. And, just looking at the base calculations we did before the show, it's dropped by about 35%, close to that level.
Oh, wow.
Right. So that is a very, very shocking decline. I mean, obviously, it was partly expected because government services were on, essential services were on, but then private sector activity had taken a pullback. Now, one of the ways in which we sort of tried to reconcile this difference between public consumption in the expenditure side and public spending on the industry side is that the role of transfers, particularly food transfers, cash transfers, could have played a role in this. Obviously, government investment also pulled back quite sharply. So, some of that also might be reflected in here. But certainly from a perspective, private sector is showing signs of significant amount of weakness. And the fact that private consumption itself has dropped more than 25% indicates that the pullback in consumption and investment has been much sharper. So it's really the private individuals and the companies who have had the brunt of this particular crisis, both from a spending and from a consumption perspective.
I'll come back to the expenditure side data in a minute, but Kaushik, among the sectoral numbers, is there anything else that is surprising? Construction at probably -50%. The rest was, I suppose, rural construction that continued. Manufacturing -39%. The remainder would have been the essential services part, perhaps. Anything noteworthy that needs to be discussed on the sectoral side before I go to expenditure?
We can spend our time looking at these numbers, and in a few quarters' time, we'll be analyzing again a different set of numbers. But, a few things, like if you see that financial services, that part of the growth, the contraction is slightly lower than what I would have thought. Whereas in, for example, electricity also is -7%. So all these numbers, this kind of uncertainty band, you have to live with, and no point, trying to put too much emphasis on each sectoral number. The broad point what Rahul made is that the private sector is under tremendous stress, and today the moratorium is getting over. So we'll get to know what is the demand of the restructuring, one-time restructuring of loans, and that will give us some idea about what is the pressure point that people are facing actually, because till now we had the 6-month moratorium. We actually could not feel what was the actual pain, and going forward we could actually get a better feel of how things are going to play out. Now, the thing is, the problem that will happen is that, in my view, that corporate sector profitability has got badly hurt in April, June, and even in January, March, it was pretty bad. And the issue is that even before this COVID-19 hit us, corporate sector profitability, if you measure it by gross profit or net profit as a percentage of GDP, for all these companies taken together, you'd see it would have fallen quite sharply even by October, December 19. So we were already starting from a weak point, and then we got this massive shock, growth shock. And we have seen corporate sector profitability taking a big hit in April, June. Now the question is, do they have the wherewithals to kind of pull back quite sharply like it happened after the Lehman crisis in 2008? Within 6 months, the corporate sector was back to the pre-Lehman levels as far as profitability is concerned. And that time, the corporate balance sheet, the banking sector balance sheet was also pretty strong, and that could support the credit growth, which the corporates were going and asking for to invest. So this time around, this profitability plunge that has happened will take time to kind of come back to the pre-COVID-19 levels. So we are seeing that credit growth is already very weak, and it will remain weak, and that's why we are a little bit more negative on the longer term outlook for growth.
It'll tie into what Rahul was saying, which brings me to the expenditure side, Rahul. I mean, the 25% fall in private consumption is perhaps not surprising. I would assume that the question would be, where does it go to in the next quarter? What is the corresponding increase in the fixed capital formation side? I don't know if you have estimates or a sense of how you expect it to move.
So we do think that private consumption recovers faster than private investment. Already there are signs that discretionary spending on, say, car sales and some mobility numbers are showing improvement. But certainly, negative growth is likely to stay with us for at least one more quarter, if not two more quarters. And investment growth is something that has already been weak. We have to admit that this is, I think, the sixth or the seventh straight investment negative growth quarter that we have. So the slowdown has been there for a while, and as Kaushik was saying, there has been a big hit on profitability, and not just from a top line. Revenue growth is likely to stay weak, so there's no incentive really to invest in a big way. And the government push also on the investment front cannot be as strong as what happened in the Lehman crisis, simply because there was significant amount of fiscal space at that point, and we were coming into this particular crisis with very little fiscal space on the balance sheet, right? So I think that this time round, the recovery cycle in private sector balance sheets and the activity levels is probably going to be far more slower and shallower than what we have seen in the past.
So tell me, Kaushik, what are your estimates, given that we have the high frequency data, which I know everyone is measuring very, very closely. So at Deutsche, for instance, what are you expecting in Q2? And then now, based on this number, will we see revisions to your full year numbers? Is that likely to go far deeper into the red?
So, we always had a 8.5% contraction for July, September. Even when we had a minus 16.5% contraction for April, June in the beginning of the period, which we subsequently, downgraded to minus 20 when we had the whole set of data. But we haven't touched that minus 8.5% for July, September. And, it looks like it'll fall in line even if you expect that sequential momentum to have increased in July, September. But it can only come up to a certain level. If you've lost a lot of momentum, it can only pick up to a certain level. So from a YOY perspective, you can still end up with 8.5% YOY contraction. If you look at the core infrastructure number that came out for July, it's still 9.5-10% contraction. So IIP will also be minus 9.5-10%. So without knowing all the details, we need to wait till the whole July September number set, and then we can take a final call. But 8.5% contraction is something we can work with at this point of time. We had a minus 6.2% growth estimate contraction for FY21, with a scenario that it could be as large as 8% in the worst case scenario. It looks like, given this minus 24% contraction, you're heading more towards that minus 8% rather than being at the 6% range. So anywhere between 6 to 8% contraction possible. That also depends on, in the second half, what kind of recovery we could expect depending on the COVID-19 pandemic, how it kind of takes shape. But overall, we are comfortable with a 6 to 8% kind of contraction at this point of time.
Rahul, I know you revised your numbers relatively recently. Would you see reason to revise them once again?
No, not as of today. I would say, we have a very similar number for the second quarter of the fiscal year at about minus 8%. My bias, looking at some of the high frequency data, is that it could be a tad weaker, but I think that is directly a reflection of the COVID health crisis, kind of stretching on and possibly eating into the festive spending, So I would be worried about having a little bit more downside risk for the current fiscal. We are still comfortable holding a 6% number, given that the rural sector, particularly agriculture, seems to be in decent shape and could play a mitigating role here in supporting activity at the margins.
Okay. I do want to come to the policy side, and I know these questions may not be entirely new. We've been debating them for 3 months, but the questions have only gotten deeper when you see these kind of data points, Kaushik. Where is the policy response to this? Are we entirely depending on monetary policy to lift us out of this? Because at the government level, if you look at consolidated center plus state, we're still sort of having a fight about who's going to get money and at what level, and who's going to borrow or not borrow. Isn't this classic situation for large government spending?
So, given the lack of fiscal space, it is quite clear that, your monetary policy will have to do the heavy lifting. And today, in principle, RBI delivered a rate cut, which could have come on 6th August, but they did not do it. And we are expecting, indirect kind of unconventional measures to come either on 6th August or soon after that, but it didn't come. And today they increased the HTM limit for bonds. And, so they're basically essentially saying that we'll keep rates for lower for longer. And there was a bit of doubt in the market in the last 3 weeks, given the hawkish MPC minutes, whether RBI will reverse its accommodative stance or will, say something, kind of quite negative for rates. So today's action more or less kind of, gives that comfort that RBI will hold on to its lower rates for longer mandate for a long period of time. And this GDP data will help kind of buttress that view. So that is from the RBI side. We do not expect any more rate cuts. I mean, if RBI were to do something, possibly one token 25 basis points rate cut, but we have given up hope. So we don't expect anything, meaningful for the markets. So even if RBI does 25, it doesn't matter for the markets. What matters is that how RBI manages the demand supply dynamic of bonds, given the amount of fiscal pressure and the amount of supplies that will come from the government. And you have seen that states are asked to borrow more. So it will continue over the next 6 months or so, and not just this financial year, even next financial year. So that is a challenge, and therefore we are not expecting too much from the fiscal side, maybe another 0.5% of GDP worth support. That itself will take your fiscal deficit for the center to 8% in our calculation, and states are supposed to go up to 4.5%, 5%. So you're talking about a total fiscal deficit of 13% in this fiscal year, which pushes up the debt GDP to 84, 85%. So I guess even if we wanted more fiscal stimulus, that would not be forthcoming in this fiscal year at least. And the banks will have to do the intermediation job of giving more credit. Whether it works or not, we don't know, but that is how they're kind of planning it. And RBI will be giving the bigger support for rates to remain on the lower side for a longer time. So that's how we are looking at it.
Rahul, you would agree, you would not think that there would be pressure in September, October for the government to come out with another package larger than 0.5% of GDP?
So we have a expectation that they might do a small, very targeted stimulus of about 400 to 500 billion INR, trying to basically get certain parts of the economy going. But then I would take what Kaushik has said. I'm in broad agreement with it. I think there is little fiscal space, but then it all comes down to a policy trade-off, right? I mean, the risk of not doing enough or not doing more than enough, it's a question of judgment. Is that you end up with some permanent economic scarring, loss of economic capacity, given that health crisis is still going on. And so from that perspective, the trend growth itself might be impacted, right? And you may sort of be in this vicious circle of not being able to service your debt based on lower expected growth, right? So and so it is a difficult policy trade-off, but then our view is that given India's debt is largely owned within the country, maybe, and our external position is very strong. We can actually maybe run a little bit more hot on the policy side, whether it's monetary policy, fiscal policy, and both of them probably need to act in tandem, right? So I think ultimately what we have been telling clients is that RBI's balance sheet expansion is something that's almost inevitable. Now, whether that happens through fiscal or that happens through monetary channels, it probably will be a combination of both. But the earlier we sort of step in to kind of ring fence companies and the private capacity that we have built up, the better it is for future growth and probably debt servicing in the future as well.
Since you spoke about it, Rahul, I'll just ask you, how much emphasis are you paying to the inflation story, in the sense that, it almost sounds incongruent to be talking about and worrying about inflation on a day when your GDP number is contracted by 23%, but the reality is that those numbers are there. Would you expect it to pass? And while we may not get rate cuts from here on, monetary policy would remain ultra easy, both in liquidity and on rates?
So I wouldn't say inflation doesn't matter, but certainly there are data issues, like there are data issues in our growth side. We have data issues on the inflation side, but certainly I would think that a certain increase in price levels have to be expected, because certain businesses which are used to certain amounts of capacity, if they still have to remain in business, they will have to increase prices, because the cost of what the pandemic does and the way the service industry is changing, you will have to see permanent price increases. Now, the question is, do we interpret that as an inflation shock, or do we interpret that as just, transaction costs have increased to undertake certain businesses, is something I think the central bank will have to look more carefully. But then we only have 2 months of high frequency data on a sub index level. So I would think the RBI would ultimately pay a lot of attention to what is the nature of the inflation shock, and they will set policy according to that. Having said that, I think it's there's a revealed preference not to breach the given mandate of 6% inflation, and until the time we see inflation come down materially, it's probably unlikely we see a reduction in rates.
Kaushik, last question to you then to help us close off. Two-part question. One is, at this point in time, how complex are the policy choices to your mind, even for monetary policy, as we were just discussing, but also if the policy toolkit that has been employed so far is what we have to play with, what are the most effective parts of it? Is it the restructuring exercises that banks will do? Is it the Manrega part, which will perhaps continue to support the rural economy to some level? What are the tools that we think will help the economy recover slowly, apart from, of course, the organic improvement in activity levels if and as the health crisis diminishes?
So first of all, more than any other policy measure, what you need is a solution to the health crisis. So if you get a vaccine or if you get a cure, that will be the best kind of policy support that we can get. But we don't know how soon we'll get. Hopefully, by April, June of next year, if the whole global economy and India manages to get a vaccine, things will kind of look better from there on. So that's something left to luck and chances, and we don't know about that. Now, in the absence of clarity regarding when we'll get this, kind of vaccine or cure, what can you do? Now, as I said, like on the fiscal side, space is limited. They might give another 0.5 here and there, but you'll not feel like you're getting a big bang kind of support. So then you're left with support from RBI. Now, RBI has many competing challenges. So what happens is, if you have inflation target and they're kind of looking at a point number of 6%. So if the number comes at 6.9 or 7%, and there is a possibility that August inflation will again come at 6.97%, then what does RBI do? I mean, their hands are tied because you're asked to kind of maintain that number, even if it is laden with food and fuel. You don't have much choice. So then you're left with all these unconventional measures that you can do to keep yields at least on the lower side. So the entire focus now shifts to the fiscal demand side and supply side bond dynamic, where we know that supplies of bonds will be huge. So question is, who will buy these bonds? So the issue is that before this HTM increase was announced, if you're not giving comfort to the banks saying that, you buy the bonds, we'll allow you to put it in the HTM, why will the banks want to buy bonds? And the yields would have moved up. So RBI has done the right thing today by increasing the HTM limit for bonds. The other thing which RBI has done in the market, which you must have seen, that RBI has allowed INR to appreciate against the dollar. So RBI was buying a lot of dollars till now, and that was adding to liquidity, either in the spot market or it was pushing the rates in the forward markets higher. So you can't control everything. You can't control liquidity. You can't control INR USD, and you can't control rates. So they are now trying to manage rates, and in that quest they have allowed the INR to kind of appreciate, because my take is that from October RBI will have to buy even more bonds, and that will keep on adding to liquidity. So you don't want both dollar liquidity to come to the money market because you're buying so much dollars, as well as you're buying government bonds. So there is a kind of lot of dilemma that RBI has. I think slowly RBI is giving more importance to keeping rates lower and allowing the currency to appreciate. And I see more bond buying from RBI in the second half of the financial year, and that's the only thing that you can hope to keep rates lower. Otherwise, the fiscal dynamic itself will just push yields higher if you don't have any more rate cut expectations. And even if you have 125 basis points rate cut, market always works on future expectation, and if they're saying it's almost end, it doesn't matter. So it's all about the RBI's bond buying program, which can keep yields lower.
Sorry, Rahul, I completely forgot to speak of the export or the net export side. So can I just throw a question to you on whether we could see any material improvement on the external front? I know exports have picked up a little bit, but could that be a material improvement in the coming quarter?
So we do think there will be a slightly better performance on the exports compared to the imports, largely given the state of the domestic demand. But then a lot of it will also probably come down to how the prices are moving. I think one of the reasons why we didn't see a significant improvement in this particular quarter was partly on account of the prices being, moving around. There was that deflator impact kind of going through. But then certainly, I think net exports will probably play a relatively constructive role as far as being a natural stabilizer in the system from a growth perspective.
All right.
Just by the way, net exports in this quarter contributed 5.5% to growth, just because imports contracted -40% and exports contracted -20%. But that is a mirror reflection of investments being down -47%. So contraction will come down. Net exports, addition to growth will come down. So that's a kind of mirror reflection of the economy showing some traction in domestic demand.
I see. Understood. Thanks so much for pointing that out. I'll close off the discussion on that note. Look forward to reading both of your notes, which I'm sure will have a lot more perspective, but really appreciate you spending time here on BloombergQuint. That's Rahul Bajoria and Kaushik Das giving us a flavor of the GDP data. Thanks so much for watching.
Thanks, Ira.
Thank you.